What's up, Squares? Harold Perkins here, and today I'm going to talk to you about reverse mortgages. So reverse mortgages are pretty much the B-list celebrity of the mortgage industry. Nobody likes them, but they're great. What I mean by that is that if used properly, a reverse mortgage can be a good financial tool for some people. For others, it's worse than watching an Adam Sandler movie.
You're drinking the wrong water.
What is a reverse mortgage? Well, as the name would indicate, it's the opposite of a regular mortgage. Instead of making a monthly mortgage payment and eventually paying off your mortgage, you don't make a payment and your loan balance increases. In most cases, you must be at least 62 years old and you must live in the house for at least 6 months of the year in order to be eligible. And there are different ways to structure the reverse mortgage. The most common way is the home equity conversion mortgage, or HECM. Essentially, the HECM is a line of credit on your house, and that's the one that we're going to be talking about today. Since you're not making a mortgage payment, the interest that accrued for the month is charged against your available credit on the line, thus causing the loan balance to increase. So as your loan balance increases because of the interest, now you're being charged interest on the interest that accrued from the prior month. That's compound interest. So as much as compound interest can work for you on a CD or savings account or money market, it can work against you on a reverse mortgage. So why would anyone do this? Well, here's a couple of scenarios where a reverse mortgage changed people's lives when they needed it the most. Fact is, there are a lot of people out there who lived paycheck to paycheck most of their working lives, so they don't have a lot of money saved in their retirement accounts. But when they retired, Social Security and maybe a small pension was enough to get by. But we all know what inflation has done to the cost of goods and services, and the cost of living increases by the Social Security Administration haven't been enough to keep up with the rate of inflation. So what do? You can sell your house to cash out the equity, but you still need a place to live, and the cost of housing is just as inflated as everything else. And this is where the reverse mortgage can be the lifeline that you need. So you have eliminated your housing expense other than property taxes, homeowners insurance, and HOA. That scenario is great if you currently have a mortgage and you're looking to eliminate your mortgage payment. But what if you already owned your home free and clear? In that case, you may not have any debts to get rid of, but you still need more money coming in each month. The reverse mortgage can do this for you too. I recently talked to a client who had lived in her home for nearly 40 years. Unfortunately, her husband passed away about 10 years ago. Since her husband passed, she had not done any maintenance on the house. It needed a new roof, air conditioning, and an entire laundry list of repairs and upgrades. She had quotes from contractors that totaled nearly $200,000 to complete all of the deferred maintenance that had stacked up over the years. Well, she did not have that kind of money saved, and she could not qualify nor afford the payments on a regular Ford mortgage. And she did not want to sell her house where she had raised her family. Reverse mortgage was the solution. Since she did not currently have a mortgage, she had the equity sufficient to fund the repairs. And most importantly for her, she did not have to sell her family home. Nice. Another client that I recently helped was still working but had to take a pay cut a couple of years ago due to COVID. He had also refinanced his regular Ford mortgage back in 2020 when interest rates were at their lowest. But unfortunately, his reduction in income was unforeseen, and he found himself in a situation where he was no longer able to afford his regular mortgage payment. As a result, he was getting behind on his other bills, and his debt was increasing rapidly. He could afford to make a payment, he just couldn't afford to make the payment that was due on his mortgage that he had. And he didn't want to sell his house, so the reverse mortgage was the answer. Yeah, that's right. While a reverse mortgage does not require a payment, you can choose to make a payment each month. The great part about him making a payment on his reverse mortgage is that he covers the interest that accrues each month. Remember earlier when I talked about compound interest? Well, that's not happening to him because he's making a payment that covers the interest that accrued from the prior month. So if in the future his employer restores his pay to what it was pre-COVID, he might choose to refinance his reverse mortgage back into a regular Ford mortgage, which would have a payment that he could afford. Okay, I've talked about a lot of the positives of a reverse mortgage. It's only fair to talk about some of the negatives. The big one is cost. Reverse mortgages are expensive, the biggest expense being the upfront mortgage insurance. So reverse mortgages are FHA insured loans, and there is an upfront 2% charge for that insurance. This is collected out of your equity at closing, so if you borrow $200,000, you owe $204,000 before you even get started. That's a lot. And on top of that upfront charge, there's an additional 0.5% charge per year for mortgage insurance. But you also get a lot for that mortgage insurance, and I'll talk about that at the end. One other negative is the distribution limit during the first year of your reverse mortgage. Your cash access is limited to 10% of the credit line. Now, that's 10% in addition to paying off any existing liens on the house. The reason I categorize this as a negative is that you may have intended to access more than 10% of your equity, but you would be forced to wait until the anniversary of your closing to get the additional money. The idea is that it forces a kind of cooling off period after taking a reverse mortgage to protect against an unscrupulous person who might be trying to scam an elderly person by taking all of their equity out of their house. So we're not mad about that, but it does force careful planning and scheduling if you want more than 10% of your equity. The last negative to talk about today is possibly the interest rate. And so while there's no payment due, there is still interest being charged. Most reverse mortgages are adjustable rates that can adjust every month. But the funny thing here is that the adjustable part of the rate isn't the problem. Quick side note on how adjustable rates work. They have two components, the index and the margin. The index is the part that changes with the market. The margin is fixed, it doesn't change. Index plus margin equals your interest rate for that month. But here's where it's tricky. Loan originators make more money if they can sell you on a higher margin, because essentially what they're selling you on is a higher interest rate. You can't control the index, but you can control the margin. It's just that most people don't know about the margin in order to know to ask about it. Well, now you know. Okay, but for most people that reverse mortgages are the right tool, we maybe don't care about the interest rate or the closing costs. Here's why. In most cases, if the reverse mortgage is right for you, then you're not trying to pay off your house before you die. This could be because the equity in your house was always intended to be used for your retirement, or maybe your estate is not counting on the equity in your house for future family wealth, or maybe your current financial situation is such that there would be no other option other than selling your house. But remember earlier when I talked about what you get for all of the mortgage insurance you paid to get the reverse mortgage? At the time of your passing, your estate or your heirs can pay off the reverse mortgage in order to keep the house in the family. But the most they will pay is 95% of whatever the appraised value is at that time, regardless of how much you owe on the mortgage. So some of the perceptions of a reverse mortgage are actually misperceptions. You are not selling your house to the bank, you own it the entire time. Your estate does not have to pay a ridiculous amount of money to buy the house back after your passing. The worst would be that they would have to refinance the loan balance, but only up to 95% of the appraised value. You only have to have enough income to support the property taxes, homeowners insurance, maintenance, and utilities of the house. The loan is not credit qualifying. Poor credit does not disqualify you. However, certain credit histories might cause it to be necessary to set aside part of the credit line for property taxes and insurance. You can choose not to make a payment, make a partial payment, or pay the full amount due each month. Totally up to you. And you can ask me questions in the comments below or message me on any of my socials. I'll write you back right away. Also, if you found this information useful, or if you know anyone that's interested in purchasing a home or refinancing with a reverse mortgage, please make sure to hit the like button so they can see videos like this too. Later, nerds.